Okay. So I'm waiting till 2:10. If the others are not in, then I'll just start the session.
Sure.
Okay, 2 minutes more, 2 minutes more. Can you see my screen?
Yeah, I can see the screen.
Okay. Okay. A minute more. Let me send the message again. Okay. It's 2:10, so I'm going to start. Good afternoon. Good afternoon, and welcome to month 2 of our mentorship. Wow, somebody just joined. Okay. Jafet, you're in time. Okay. So I hope you can hear me, Jafet.
Yeah, yes, please, I can hear you.
Okay. Okay. So this is month 2, teaching number 3, and the second month will be 10 sessions or 10 topics. So this is the third one out of 10. And then let's get straight into it without wasting time. So we are going to be talking about elements to a trade setup, and the way we are going to be viewing the markets from now on is going to be based on these two things, that's A and B. And then per our belief, or the for lack of word, let me use culture. For the culture we are going to be using in our community as traders, we are going to be basing our trades on two things, and these are the context or framework surrounding the idea of the trade. And then the second thing is the reference points in institutional order flow. So when we look at the market, or when we look at the forex market, we are trying to find a context or a framework behind a reason why we go on our terminals and then place a buy or a sell. You understand? So these contexts include, or these frameworks include, expansion, that's number 1, retracement, number 2, reversal, number 3, and then consolidation, number 4. And everything we are going to do, every action we are going to take in the market is going to be based off of these 4 contexts or these 4 frameworks. Now, knowing the frameworks, we have to have reference points in institutional order flow that we are going to refer to and say, okay, when price gets to this level and it shows me this framework, this is the reference point I'm going to use to place my trade. You get what I mean? And then those reference points include number one, order blocks. Number two, fair value gaps and liquidity voids. Number three, liquidity pools and stop runs. And number four, equilibrium. So everything I mentioned earlier, everything that the title even says, elements to a trade setup, the elements, things that come up to make sure our trade is our trade, things that come up to make sure the setup we are trading is valid. You understand? Because to be able to trade, to be able to place a trade in the first place, you have to have a setup, right? And then that setup has to be validated by um certain frameworks, certain systems. You understand? Some people may call it confluences. You understand? They want to see certain confluences mark out. Okay, A is expansion, B is order block, C is this, C is that. That's the framework we are going to be using for our trade. Sorry, that's the framework we are going to be using for our community, and then the frameworks we are going to be using to set up our trades. Now, market efficiency paradigm. Now, when we say paradigm, we mean the framework. Again, the word framework is being used. Paradigm means the way we do things. Like when you go to America, they wear coats, they wear suit and tie. You understand? But when you come to Ghana, you can see some people wearing batakari. You can see some people wearing kente. That's the cultural aspect of it. But when you look at modern, or let me say Gen Z, when you look at Gen Z fashion trends, you can see someone wear a jersey on a jeans. That's the way he does things. That's his paradigm. That's his framework. That's his coming up. That's the way he is, who he is. You understand? So understanding the market and knowing these things, that's the frameworks behind our trade setup. We are going to have an efficiency paradigm. We are going to have an efficiency shift. You understand? We are going to shift the way we see market and how we do things in the market. So understanding the first things I displayed, that's this. Understanding two elements, these two elements is going to give you a shift in how you see the market, in how you see price action. You get it? So what is going to help you do is to understanding these two tools will give you a great shift in mindset and how the smart money interprets price. So if you understand the tools I displayed first, you're going to have a shift in the mindset, in a sense that you're not going to base your trades off of, okay, price just came to a certain level, now let me trade. And though that works for some people, but this is what we are accepting in our community, and we are saying, okay, we want to have a mindset, a reason for taking a trade, not because market has got to a certain level. And some people will say there's something in price, there's something in this level that is bouncing price off of that level. How can there be something in price? Have you thought of that? There are levels where market makers precisely live in the market and make reference to in the future. You get what I mean? So understanding these tools will give you a shift in mindset and how the smart money interprets price. Is going to give you a view on how those who make the market see price action, and then it can aid you in making profits in the market. So from here, you'll be able to look at the marketplace with an expectation of knowing what tools to apply based on what the market is providing you at the moment. So an example is when you see an expansion, you are going to look for a tool like the order block. When you see another person is trying to join, great. When you see a retracement, what you are going to look for is a liquidity void or a fair value gap. When you see a consolidation, you are going to look for either equilibrium or a half point. Let me make sure nobody can reach my phone now. Great. Now, what makes the idea favorable for a trade? Not simply this level is this, that level is that. That's why I'm taking this trade. What makes the idea favorable? Understanding this is going to make sure you have a you have what? Understanding this is going to make sure you are able to understand why you favor this idea over this idea. It's going to give you a reason why you favor a sell over a buy. It's going to give you a reason why you want to place or you want to go into the market and then hit the sell button and or hit the buy button. Going forward, there has to be a foundation that builds the reason you want to take a trade, a specific trade, you understand? Whereas we were taught entering the forex market that okay, there's a certain level. I've always had a problem with this. People tell you there's just a certain level in price that when in markets that when price gets to, it wants to bounce off of that level. It doesn't make sense to me. Understand? There's just a certain level. What is in that level in price? Remember, when you are looking at price action, there's nothing in trading view that says there's nothing in trading view that shields price to a certain corner. You get what I'm trying to say? There has to be a foundation that builds, you have to build your trade off of a certain foundation. You can say that, okay, I've seen markets ranging. So what do I expect next? I expect an expansion. That's valid. You understand? I've seen markets reversing. What do I expect next? I expect a liquidity pool hunt. You get what I mean? And each of the elements mentioned in here is mentioned to give you a specific framework and a context in the market you are going to be trading in. I mentioned that earlier. So with great precision, you can tell the characteristic the market is trading in. So these things are giving you these tools are giving you to make you understand the precision in price. You understand? Yes, yes. So with great precision, you are going to be able to tell, you can tell the characteristic in market. Sorry, you can tell the characteristic the market is trading in. Exactly. So when you see a level of equilibrium, when you see markets bouncing off of a certain level, you can tell the characteristic that the market is in. And then that characteristic can be something like consolidation. You understand? Let's go forward. Now, this is very interesting. If you understand this, you are going to get the whole makeup of forex market. You are going to get the whole makeup of price action. It's called the Interbank Price Delivery Algorithm. Now, orders used to be filled in the market by humans, you understand? And back in the days when we had floor traders, there was nothing like charts, candlesticks. You can't see the candle going up or coming down. You can't see something happening in price action. You understand? You can't see it. You just hear people saying certain things and then you say, okay, based off of what I've heard this person say, I'm going to place a buy trade. Or based off of what I've heard this person say, I'm going to place a sell trade. You get what I mean? But then with evolution, an invention came called the algorithm, the Interbank Price Delivery Algorithm. It's an algorithm that sets price. It's an algorithm that fills orders in the market. Now, price delivery is at the center of it. And then we are saying that, okay, per every level of, or for every level of price action, we have a certain framework or we have a certain, for lack of word, I'm going to use outcome. We have a certain outcome price is going to display. You understand? So let's go straight into it. The first level is consolidation. Second level is expansion. Market always starts from consolidation. And then if you hold on to it, I'm going to show you other slides where you okay, I'm not going to go ahead of myself. You see markets trade in a certain range and then immediately expands out of that range. You get it? That's expansion. So from consolidation, we go to expansion, then we go to retracement. And sometimes after retracement, we come back to expansion or we come back to consolidation. But have in mind, market always starts, or price delivery always starts from a consolidation phase. So you can randomly enter the market and see, okay, price is doing something in the market. Based off of what you are seeing price doing in the market, you can say, okay, from this level, it's going to go here next, or it's going to go here next. It's quite easy if you understand the basis of it, and this is the basis. Consolidation, expansion, retracement, reversal. There are only 4 things that market can do. If you streamline your focus to these 4 things, it's going to give you a precise, or it's going to give you a certain level of accuracy in predicting price movements. It's going to be very, very easy for you to say, okay, I've seen price do this, henceforth, I'm looking for this to happen. You understand? So, what is the Interbank Price Delivery Algorithm? It's an AI price engine that fills orders whenever traders place trades. So, immediately you place your trade, there's an, okay, this doesn't apply to retail traders. It applies to the interbank. That's why you say interbank price delivery. It applies to the market makers, those who set the price of the market. So when they place orders, it's an AI that fills the order for them. You understand? That's what we believe. That's what the person who taught me how to trade, that's what he believes. And then it has worked for him. It has worked for me too. That's why I'm teaching it. This is what we are going to believe going forward to aid our what? Our price action forecasting. And this algo is based on certain principles that interchange with time. And these are the principles. The principles I'm reading over here is what price action is based off of. That's consolidation, expansion, retracement, and then reversal. Consolidation, expansion, retracement, and reversal. Since this was programmed by humans, it has limited intelligence and can be studied. So um just like someone will do a chair, you understand? I'm looking at a chair right now. That's why my mind went to a chair. Just like someone will create a chair, and then he'll tell you this chair can only do these things. You can't send the chair to space. By the time you reach space, it's going to burn, unless it's in a spaceship or something. But this chair cannot fly. This chair cannot, it cannot cook. It can only be see it can only be placed at a point for people to sit on. Apart from that, you can raise it to certain points. Apart from that, you can take it and shake it. Apart from that, you can dismantle it. You understand? There are limited things to what the chair can do. You understand? That's the same way we are seeing prices. We are saying, okay, if this AI was programmed by humans, that means it has a limited number of things it can do. You get it? And these things that it can do can be studied. Again, they are consolidation, expansion, retracement, and reversal. Someone will ask, why am I hitting on these things so much? Because immediately you understand these things, price action is going to be easy for you to read. Understand? Let's go ahead. Now, the markets are highly manipulated. Think about it. Those who created the market are going to create it to their favor. Business is created to make profit, right? And they are not going to consider the fact that, oh, some guy in Africa, not to even talk of Ghana, some guy in Africa is trying to trade, so let me create a system that can make him prosperous. No, the market is highly manipulated in favor of those who created it. You understand? So if it's in favor of those who created it, then we can see fingerprints. Like I was saying, it was programmed by humans, so you can see fingerprints when it's doing something. You can say, okay, like when I come to your room and I touch something of yours, right? And then you take, I don't know what tool they use to watch fingerprints on certain devices, but you take a certain tool. Sometimes you can even see it with your bare eyes. If I touch my screen like this, I can see that, okay, my fingerprint is there. I've touched my screen. The way I've touched my screen was manipulated by me. I touch it to be in my favor. I touch it to something I can see in my mind, and then it was in my favor. That's why I touch a specific side of my screen. So you can see my fingerprint. You can see when you open my laptop, you can see that, oh, Desmond touched this specific part of his screen. Are you getting what I'm saying, guys? I need interaction so that I know I'm doing perfect
Yeah,
delivery.
yes, please. Yeah.
Okay, okay. So you can see the fingerprint of price in the algorithm. You can see it. You can see that, okay, at certain points, the market is consolidating. At certain points, it's expanding. At certain points, it's retracing. At certain points, it's reversing. You understand? And from this operation, it gives you clues on what it's trying to do next. So if you see a consolidation, you can say, oh, I've seen this clue, so I'm waiting for this to happen. I've seen this, so I'm waiting for that to happen. You understand? This is where you develop your anticipatory skills as a trader. So knowing this is what is going to make you say, okay, I'm able to forecast price to this level of precision. Maybe my level of precision in forecasting price is 70%, 50%, 30%, 90%. You understand? Let's go forward. I think I've explained this already. So only four things markets can do. Again, consolidation. That's where every price action starts from. So when you go to a certain price, when you go to a certain market and then you see it consolidating, you know that it's trying to start something. Yours is to sit down, analyze it and look at what it's trying to start and then say, okay, based off of this thing that I've gotten from, based off of the thing I've gotten from price action, I'm going to forecast this. You understand? Based off of the clue I've gotten from price action, I'm going to forecast this. So consolidation, expansion, retracement, reversal. Consolidation, expansion, retracement, reversal. It always starts from consolidation. Just like the human being. I don't know how this example is going to make sense, but the human being always starts his day when he wakes up from bed. You understand? There's nobody in this world that doesn't sleep. Everybody sleeps. You get it? So you start your day, or you start your whatever you are going to do in the day. You start it from when you wake up from bed. You understand? That's the same way price starts. Price is sleeping in a consolidation phase, and then it wakes up. Now, when you wake up, you have a boatload of energy, so you're able to do many things in the morning as compared to when the day is going, like in the afternoon or when the sun is setting, in the getting to the evening. You understand? You have a lot of energy when you wake up from bed and say, okay, you've woken up from. Another person is trying to join. Hold on. Okay. No, someone left rather. Yes.
Oh,
S-
it was me. I got disconnected.
What?
It was me. I got disconnected, so I tried joining.
Okay, okay, that's fine. So based off of you waking up from bed, then you can see that, okay, I have enough energy to do this. So your morning actions are going to be energetic. They are going to be very impulsive. You get it? Unless you are those kind of people that say you want to wake up and do meditation and then you sit down in the bed and you're doing this. People have their beliefs. I'm not against anything, and I don't oppose anything. If that works for you, that's fine. But you get the idea I'm trying to cast for you, right? You wake up and then you have energy. You have energy to do something. You have energy to go to a certain point at a certain time. Let's go. Now, this what I was saying. The market always starts from consolidation, then it goes to expansion. After expansion, it comes back to retracement, or from expansion, it can continue, it can do another consolidation, or from expansion, it can take out a liquidity pool and then reverse. You understand? So consolidation, expansion, it can go from expansion to consolidation again. It can go from expansion to retracement. It can go from expansion to reversal. The market always starts its movement from a consolidation pattern. Then it goes on to do an expansion. From there, it can decide to do a retracement, reversal, or go back to a consolidation. These four conditions interchange throughout the marketplace. So if you are watching a certain market, you are watching a certain asset's price action, you can see that these conditions are interchanging. It can go from consolidation, expansion, expansion, reversal, reversal, retracement. These things are, you know, interchanging. To trade these conditions in price effectively, you first have to understand where price is currently and where it's likely going to, or where it came from. So you have to understand what price is doing currently. You see that, okay, I can see price doing a consolidation. So if I'm going to trade this effectively, I must understand what price is doing. If you compare some traders to okay, comparing yourself to new traders, you are going to see that he doesn't understand when the market is consolidating. You get it? He doesn't understand when the market is reversing or doing a continuation pattern. He doesn't understand these things, but if you understand them effectively, it's going to give you an understanding of where price is likely going to go to next. So all moves in the market starts from a measure of consolidation, because that's where the markets are building orders. The market makers are building orders. Now, when I go for it, you see what consolidation looks like. Consolidation is like price trading in a certain range. So it can be trading in this range from my left hand to my right hand. The space in between, it can just be bouncing off of this range. You understand? So they all start from a measure of consolidation. Now, when market is in a consolidation, it means that the market makers are building orders. They are taking buy sells, 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 buy sells. And then at the point where market expands from this consolidation range, or from this consolidation or this range bound market, that's when, sorry, at the point where it expands from this range bound market, it means, sorry, the market makers keep price in a tight range until there is enough money on both sides of the range, upper and lower ends, to be absorbed. So they take up orders from down, up, down, up, down, up, down, up. Then they look at both. They look at both levels and they say, oh, they look at both levels and they say, okay, now there are a lot of orders on the upper end of this consolidation range. So that's what we are going to go for. Again, keep in mind that business is made to generate profit to the owner, right? So they are saying, okay, we've seen a lot of orders at the upper end of this market. So what are we going to do? We are going to expand through that market and then give a continuation. Sometimes you can say, okay, there are enough or there are a lot of orders on both sides. And then as greedy as we are, that's the market makers, as greedy as we are, we want all of them. So what they do, they expand to the lower side, take out the liquidity pools, and then what? They reverse and go to their intended price movement. That's why I was saying markets can only do four things: consolidate, expand. From expansion, it can go to reversal. From reversal, or from expansion, it can go to retracement. From retracement, it can go to a reversal. So it retraces, goes up, reverses, and takes out that liquidity pool before it goes up. Then I'm going to, as long as you keep joining the class, you are going to understand what I'm saying. You are not going to understand it in just this one sitting. It doesn't make sense. That's not how things are done. You understand? But if you are not able to join, you can be watching the YouTube, and that's fine. And when you watch it too, please subscribe and share. Share to your friends that you think, okay, they are interested in the forex market and they will want to know more, and then they can join the community too. That's just by the way. We do not always know which side is going to be absorbed first, so we always wait for the expansion. So when price is in the range bound, when price is range bound, we don't know the side is going to go to first. We don't know whether it's going to go down first or up first. So we always wait for the expansion. However, some people have studied enough to know what is going to happen after the consolidation. So most times when it's consolidating, they just enter the market because they know. You understand? They know. They've studied it enough. And that's the whole point of trading. You have to study price action enough to say, okay, I'm comfortable or I'm confident to enter this trade. Why? Because I've studied it enough. You understand? Sometimes the market expands so far that we are not able to catch the move. So in this case, we wait for the retracement or the next consolidation. Now, you may have noticed this. If you watch price action, you can see that sometimes it goes so far high, so far, so far high, so far high. Yeah, it's correct. It sounded wrong. It goes so high that you are not able to catch the move. You understand? It goes so high. It just keeps trending, moving upwards that you are not able to catch the move. And that's fine. You're not going to get every move. You understand? What happens is you wait. You wait for a retracement or you wait for the next consolidation to know what you are going to do next. You don't chase price. Again, you don't chase price. Now, this is the interesting part. Elements to a trade setup. What is expansion? Expansion is when price moves quickly from a level of equilibrium. Now, equilibrium also means not consolidation. Equilibrium is a level in consolidation. Let me clear that so that you are not confused. Equilibrium is a level in consolidation. Equilibrium is the midpoint. So so if you look at this range, right, the midpoint of this range is what we call the equilibrium. So expansion is when price moves quickly from a level of equilibrium. That's expansion. What is the importance? The importance of the expansion is when price leaves a level quickly or impulsively. This indicates a willingness on the part of the market makers to reveal their intended pricing models. So when you see price move out of a level quickly, when you see price move out of this range, you see it go up, it goes up very, very fast, impulsively, then we can say, okay, due to the price action I just saw, I can see that market makers are trying, they are trying to what? They are trying to reveal their intended pricing models. They are trying to reveal a certain point they are going to attack next. You get what I'm trying to say? So you see that, okay, price has gone up, but it has gone up with a certain level of force. Then we can say, okay, based off of this, I know that market makers are trying to do what they are trying to reprogram the algorithm to start looking for buys, to start looking for buy side liquidity. So when we see this, what do we look for in price? That becomes the question. What do we look for in price? We look for the order block the market leaves at or near the equilibrium. We look for the order block the market leaves at or near the equilibrium. So let me go back to the first slide. I'm not going to keep long. I just want to show you something. This is the framework. That's expansion. Expansion is the framework. And then the reference point we look for is what? Is order block. So let me go back. You can see that the first one, expansion. That's the framework. That's the context. Then the reference point we look for when we see expansion is what? Order block. You see it over here again. Expansion. When we see market expanding, we wait for it to come to the order block and then we take our trade. You understand? So yes, let me show you an example. Someone will say, okay, I've heard what you are saying and then it sounds interesting, but I don't know what it looks like in price. I don't know what to go and look for when I'm looking for it in price. This is what it looks like. I hope you can see it. Guys, can you see what I...
Yes, please, we can. Yeah.
Exactly. Exactly. So this level, exactly. This is the range, the consolidation range, the yellow shaded area. The color is yellow, but I reduce the opacity. That's why it looks like another color. This yellow shaded area is the what? Is the consolidation. Is the consolidation. So I was speaking to Jafet, I think 2 days ago, and then we're trying to understand what consolidation is. We're trying to differentiate between consolidation and then a range bound market. But we'll do that in the coming lessons. Now we see that market was consolidating over here. You see, down, up, down, up, down, up, down, up, down, up, down, up. It was building orders. It was building orders. Then the market makers saw that, okay, I would have left the consolidation low here. Then that will mean that price came down, swept this liquidity pool, and then reversed. You can see that. But for the sake of understanding what the order block is or how it forms, and then in the range in which it forms, I left it to this whole point. Because here too, if you go on a higher time frame, you see that I marked this level from a higher time frame. So you can see that okay, it's a full uh, exhaustion candle. And exhaustion on the lower time frame means a consolidation. So market was in this, sorry, price was in this level, in this range. It was consolidation. It was consolidating, sorry, up, down, up, down, up, down, up, down, up, down, up, down. It got here and then it expanded. It went up with force. So you can see from here, it went up. Blue, 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 blue candles. You can see that, right? The order block is
Yeah.
the order block. A bullish order block is the last red candle or the last subsequent red candles before an impulsive move higher. So okay, let me not use red because other people may set their charts to look differently. They may set their charts with other colors. So let me say the last bearish candle before an impulsive move upwards, or the last subsequent bearish candles before an impulsive move upwards. That's the bullish order block. So this is the last bearish candle. You can see that this is the last bearish candle before the impulsive bullish move upwards. So this bullish move broke above this consolidation high. So you can see it's consolidation low, consolidation high. This bullish move broke above this consolidation high, leaving this bearish candle as the order block. You understand? Exactly. So now market went up. The green shaded area, this is also green, but I reduced the opacity. That's why it looks like a different color. This green shaded area, this green shaded area is the expansion. It expanded outside of the consolidation. And then what happened? You can see that price came back down. It came here first, entered the fair value gap, but we are not looking for it to enter the fair value gap. We are looking for it to enter the bullish order block. There are cases where it enters the fair value gap and then it continues going up. I'll explain that later in the coming lectures. But it came into the fair value gap, went up small again, and then came down. Now look at where it reacted from. Where did it react from? It reacted immediately, entered the order block. You understand? And then I said earlier, let me go back. The order block, what we look for in price, we look for the order block the market leaves at or near the equilibrium. Now look at this. Which level do you see the order block format? The line in between. Can you see it? I named it equilibrium. Can you see it? Exactly. So we look for the order block at or near the equilibrium. So when you see order block, you can see another block form here. You can see another block form here at this level. That's not at the equilibrium. At or near should be something like this. You understand? Or something like this before the expansion. So this is the expansion. Price went up, started coming down small, and then it finally came down, entered the order block, and then look at this. So we can go back and say, okay, we can go back and say, sorry, I got distracted. We can go back and say, okay, when price expanded out of the consolidation phase or the consolidation range, we had an indication that market makers are trying to what? They are trying to reprice the price of the assets. We are trying to reprice it higher. You understand? They are trying to make it go high. So now we look out for what? We look out for an order block for price to come back into in order to do what? In order to take that trade and then continue the phase higher, we can put our stop loss here, over here, at this point. Sorry, our take profit here, because what are we looking for? Market moves from buy side liquidity to sell side liquidity. So we can leave our stop loss. Sorry. Let me catch my thoughts. We can leave our take profit here for market to hit it. Also, we can leave our take profit here. Also, we can leave it here. But that's dependent on your level of understanding in price and also your target profit. Understand? So it came down here, entered the bullish order block, and then did what? Expanded higher. Sometimes it just touches the tip, then it goes higher. But this one, it came all the way to the midpoint. No, I don't think this is the midpoint, but it came near the midpoint and then it went higher. So when you are taking a trade like this, what do? You place your entry on this line, put your stop loss over here or below it to allow your trade to breathe. You understand? Some people leave their stop loss close to their entry, and the market is volatile too. So sometimes it hits the stop loss and it ends up going in your direction. So sometimes what do? You leave it at the tip of the end of the order block, or you leave it below it. Let's go ahead.
Please, I
Elements
have a
to
question.
okay.
What if the other block is too big? Like for example, this one like this.
What if what?
Um, like the other block is very large.
It's very
For
large.
example, the
Did you say it's very large?
yeah,
Like which example?
like the one we are doing.
This one.
Yes, yes.
Uh-huh.
So if I place my entry at the open or at the wick the of the other block, and then my stop loss is far below,
Yes.
and then my like if you see if you are setting it, you can use your meter trader to see the amount of like pips and then money you are risking. Like if you
Exactly.
do the if you are setting the order. Uh,
Yes.
and so if you are doing that and then like there's your stop loss will be too much than you can afford or something. Does that mean that you can't take the trade again?
Does that mean that you should what?
Like you should forfeit the trade. You shouldn't take the
So you are trying to ask if the order block is too large, does that mean you should forfeit the trade?
trade. Yes.
Okay, so if the order block is too large, there are levels in price where, let me see if I can pull this up. Okay, so this is my chart. Get rid of this. Let's see. Get rid of this. Get rid of this. Okay, so now this is where I took it from. Now let's go to the lower time frame. Let me show you. When the order block is too large, you go to the lower time frame to look for price refinement. Are you familiar with price refinement?
Yes. Yes. Yes.
Okay. So when the order block is too large, what's up? I have network. Oh. When the order block is too large, you go to the lower time frame and then you look for a refinement in price. Now, when you go to the lower time frame, you can see levels in price where okay. Yeah, I was checking if I had data. Sorry. You can see level in price where um there's a quick or there's a sudden reaction. In other words, when market gets to that level, you can see that okay, price is reacting to this level. And because it's reacting to this level, then I can take my trade off of this place and then place my stop loss somewhere around there. Okay. Can you see why price is not getting to that level? It's because you know there's a certain level of chart you can see at per time. Okay,
Yeah.
let me look for it. I have to explain this so that you understand. Let me look for this in another scenario. In another scenario. Let me look for it in a buy scenario. I'm coming. Let me show you. Okay. Okay. Okay, let's use this example. This is the reason why I said sometimes you leave your stop loss below the range. You can see that price came close to the stop loss. And then when you are using when you are trading, brokers chart spread. So sometimes the spread accumulates for it to take you out of the trade. That's why I said sometimes you leave it below. But let's go straight into it. Let's go into the 4 hour. Let me show you how you do things. When you see a large level, this is it over here. You can see that in this is a full order block on the daily time frame. Do you get it? Now
Yes.
in this range, you can refine it and then put it here. You can leave it here. Why? Because this is also what? This is also an order block in the higher time frame order block. This is an order block, so it's still valid to use. You understand? Though there was no prior retrace, there was no prior consolidation to this forming. There was a consolidation here, but it's not, let me see. No, that was an expansion and then a retracement to continue. So there was no consolidation happening here, but on the higher time frame, it was a consolidation, and this was an order block. You get what I'm trying to say? And then price expanded out of that order block. So at points where you think the order block is too large for you to trade, you come on the lower time frame, and then what do? You go or you look into detail into the detail of the order block, and then you see levels where you think, okay, this is where, okay, oh, where's my trading view? Sorry. So you go deep into the order block on the lower time frame, then you look out for levels where you think price is going to get here before it reverses. So I'll mark my levels here. First of all, this one. Second, sorry. First of all, this one. Second of all, this one. So I'm going to watch what happens when price gets to any of these levels. So you can see price got to this level, and then immediately what did it do? It showed a certain type of reaction, but what did it do? It went down again. It broke below that low. Sorry, it broke below that level. So I'm going to do what? I'm going to take this one out. You understand? So when you take out your order block, you still go on the lower time frame to look at price action. Price action is going to give you all the clues you have to take a trade. So you go to the lower time frame, you look at price action and say, okay, I'm looking at price react to this level. Let me see more of what is happening before I take my trade. So we saw that price came here, and then what did he do? It pierced that level. Then I mentioned earlier that every time price is trying to do something, it starts from a consolidation. So now look at what happened. After I broke this level, look at what happened. What happened when it got here? It started doing what? Consolidation. Consolidation. And that level is what? That level is this same level. It's also an order block. We validate it as an order block because it was in the higher time frame, huge order block. You understand? So the order block, immediately you catch it, you know that on the lower time frame, it can go deep. It can even go to the last point of that order block before it goes up. It's still an order block. It's there to hold price. You understand? It's there to hold price from doing something new, or is there to give market makers reference to price. So any order block we see in that order block on the lower time frame, we still validate it as an order block. And this is it. It broke that level, came down again, and then what did it start doing? It started consolidating. So you can see a reaction off of this place. You can see a reaction off of this place. Now, you would ask, okay, why didn't market come back to this order block over here? It's because we've already visited this order block, the previous one. We've already visited this one. So immediately it comes and it enters that order block. It doesn't have to revisit another order block again. Or else that's what it will be doing, to be repeating itself over and over and over and over again. You understand? It didn't come all the way here again. It didn't come to this order block again. It hit here, swept this liquidity pool, and then what did it start doing? It started bouncing off, going up, 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 up. Do you get it? Jaffe, do you get it now?
Yes, please, I do.
Okay. So we can go back, right?
Yeah, we can continue.
Okay, okay. So yes, we are done dealing with the order block. Sorry, the expansion. So price expands out of a level of consolidation and leaves an order block at the equilibrium. Then we wait for price to come back to that level, mitigate the order block, and then continue going up. Mitigate simply means it comes back to to touch, for lack of word, I'm going to use touch. It comes back to touch that order block and then it continues its run higher. Then the next one, sorry, yes, the next one, elements to a trade setup. What is retracement? Retracement is when price moves back inside the recently created price range. So, okay, forget about that. Oh, there's a chart after this one, so I'm going to show you. What is the importance? When price returns inside a recent price range, this indicates a willingness a willingness on the part of the market makers to reprice to levels not efficiently traded for fair value. Let me do this. I have a problem with okay, I'm not going to say it. So when price returns inside a recently priced range, so it goes out of this range. So now it's like this, it's up, and then it retraces. It retraces down. It goes up out of the consolidation. It goes up, then retraces down. It reaches a certain level like this, right? It reaches a certain level like this, then it continues its run up. You understand? It indicates that market makers are willing. I've spotted another mistake on the part. It shows that market makers are willing to reprice the price to levels not efficiently traded for fair value. You know that when you go to a marketplace, there has to be a fair valuation in price. It has to be it has to be balanced. Price cannot keep going up, 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 up. No. Price cannot keep going up, 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 up. No, 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 no. It shouldn't happen. You understand? This is the way it happens. It goes up, it comes down small, and then it goes up again. Like the dollar compared to the CD. It came down, it went up small, and then it came back down to 10 CD again. Now it's going up small again. You understand? So we are trying to balance price. It's supposed to be price is supposed to have a fair valuation. We have to have a fair value in price. Every price has to be fairly valuated. You get it? So what do we look out for in this price? What do we look out for price when we see a retracement? We look for fair value gaps and liquidity voids. Let's go and look at what it looks like. This is it. So we see price expanded. This is a full order block. This is an order block on the higher time frame. But let's forget about the order block. We are focusing on expansion. Price expanded, and then what did it do? It came back into the range that it expanded from. You see, that's what we call this place. This whole place is what we call fair value gap. Can also be called liquidity void. So this whole place is a void. A void is like a space, a vacuum. Like someone can say, I feel a void in my life. They feel some vacuum in their life. They don't know what is happening. It's like there's a hollow space in their life. You understand? Yeah, that's what some people say. Now, this void, they reprice price to this level. They bring it back to this level to make sure there's fair valuation in price. You get it? To make sure, okay, there's no price is just moving up, boom, 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 boom. No, no, no. Make sure there's fair valuation in price. Make sure, okay, everything is fair. Buyers are participating well. Sellers are also participating well. It's not just buyers taking hold of price up to wherever, whenever. Please let me take water. My throat is dry. I beg. 1 minute. Everyone, where is that? This tea? It's okay. 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 So just to make sure buyers and sellers are fairly valuated, they value them fairly. They say, okay, buyers had this amount of orders. We want sellers to also have this equal amount of orders so that the market is what is priced fairly. You understand? So when we see an expansion, we see that, okay, this is a liquidity void. That's why I told you earlier that when price, you can see over here, when price got here, it showed a reaction. That's just a reaction to what price. That's just a reaction to the liquidity void or the fair value gap. And then I'll explain later. I told you I'll explain later why at certain points it reacts off of the liquidity void or the fair value gap and just keeps going. And sometimes it comes all the way to the bullish order block or the bearish order block. So now, retracement. When we see price retracing, what we look for is we look for the liquidity void or the fair value gaps in price. Then we said, okay, we are going to take trade based off of this whole price action or this whole liquidity void in price. Any questions before I move on? Okay, no questions. So I'm moving on. The next one is a reversal. Elements to a trade setup. What is reversal? Reversal is when price moves the opposite direction that current direction has taken it. So you can see the current direction is taking price here. Then it gets to a certain level and then reverses. It has moved the opposite direction. Instead of going up, it has moved the opposite direction. What is the importance? When price reverses direction, it indicates the market makers have run a level. Made a mistake here. When price reverses direction, it indicates the market makers have run a level of stops and a significant move should unfold in the new direction. Again, there are keywords over here, and then I'm going to let you see them. When price reverses direction, it indicates the market makers have run a level of stops. The key phrase over here is going to be run a level of stops. So when a reversal is happening, it means market makers have run a certain level of stops. They've taken out some level of stops. Again, the market is filled with buy stops and sell stops, buy orders and sell orders, buy side liquidity and sell side liquidity. And then we believe the liquidity is resting above stops. That's above old highs and old lows. We consider them as stops because when you take your trade, you place them at a high point of the market. So that's where your stop is placed. That's where, so they run that level of stop and then they reverse. When they see that there are a lot of orders at that level of stops, they run it and then they reverse direction. What do we look for in price? We look for the liquidity pools just above an old price high and just below an old price low. So this is it. Can you see it? Is it clear? Exactly. So we can see that price was going up, 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 up. Market took this price in this direction. It took out this level of stops. We can even say this one, this particular one, or we can even say, okay, this one, this particular one, this particular one. But I wanted to make it very obvious. That's why I didn't circle or I didn't outline the intermediate ones. Because for that one, you now get confused. Okay, because it continued coming down. You understand? But as we advance, I'm going to teach you more about that. So it was going up. Market took this price in the high direction. Guys, please, a minute. A minute, please. Aram. 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 Please come. Please use your phone to take a short video of me teaching, okay? Like 1 minute. I'm using it for hotspot. Okay. Here where's my keynote? So market was moving up, 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 up. Run this level of stops. It ran this level of, we can use this one too. We can use this one too. It ran this level of stops, and what did they do? It reversed. Why? Because we believe there are stops above old highs and resting below old lows. You understand? Over here too, we can see markets ran this level of stop. You can see that immediately it took out this stop, the stop over here, this low. Immediately it took out this low. It changed direction, it reversed upwards. You get it? But I use this one just so that it's very clear and obvious to you. Just so that you see what is happening. So that it's not like, okay, we are looking for the short-term ones. We are not looking for the short-term ones. We are looking for the very obvious ones. When you go on the lower time frame, you can get trades based off of what you are seeing here. But that's not what we are targeting now. I'm explaining this so that you can understand the concept. So it went up, ran this level of stops, and it reversed. It went down, ran this level of stops, and then it reversed. Went up again. Okay. I should have outlined, I should have delineated this place, but I couldn't. So it came down, took out this level of stops, and then what did it do? It reversed. And then where do we find the stops? We find them above old highs. You can save it. I'll come for it later. I don't care. I'm not looking for it. You see, it ran this level of stops and then it reversed. Again, it came up, 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 ran this level of stops up here and then it reversed. You understand? So those are the liquidity pools. Those are the liquidity pools resting above old price highs and just below old price lows. So that's where liquidity pools rest. So when you see a wick, you know that liquidity pool is under that wick. So you just aim for it, or you just wait for price to do that and then try and forecast where it's going to go next. Now the last one is elements to a trade setup. What is consolidation? Consolidation is when market moves inside a clear trading range and shows no willingness to move significantly higher or lower. I explained that. Moves in a clear trading range. This is a range and shows no willingness. It is not showing any sign to go higher or lower. What is the importance? When price consolidates, it indicates the market makers are allowing orders to build both on the buy side and the sell side. But let me read it as I wrote it. When price consolidates, it indicates the market makers are allowing orders build on both sides of the market. Expect a new expansion near term. Expect an expansion to happen near term. Now, what do we look for in price? The impulsive swing in price away from the equilibrium level that is found exactly in the halfway point of the consolidation range. That's what we call equilibrium. So what do we look for in price? We look for the impulsive swing in price away from the equilibrium level. So when we are looking at a consolidation and then we want to trade a consolidation, we look for it to make an impulsive swing away from the 50%. That's the equilibrium level of the range. So the impulsive swing in price away from the equilibrium price level, that is found exactly in the halfway point of the consolidation range. So this is what it looks like. You can see price was consolidating. It was in a range. It was going up, down, up, down, up, down. Yes, it was progressively going higher, but then it was not impulsive. You understand? It was not impulsive. So let me explain it again. Let me read it. The impulsive swing in price away from the equilibrium level. So we mark out this whole level, and then we saw what? We saw price respect this level starting from this candle. This candle came inside this, respected it. This one too came inside this, respected it, and then started going up. The impulsive. So we can take trades based off of this price action. Now, to trade in a consolidation market is an advanced concept. It's something that is advanced. So I'm not going to explain it in a way someone will feel like, okay, I'm ready to trade a consolidation. No, no, no. Please relax. As we go further, I'm going to explain it well. You are going to understand well. Yes. So it was ranging. Then it got to this level, this equilibrium level. Immediately it started touching this level. What did you see? You didn't see any candle close below this level. You didn't see any candle close. There are certain price action that allow price to close below that level. But generally, we look for an impulsive price move away from the equilibrium level. So you see, it got to this level and then it reacted fast. So by you seeing this thing, you can say that okay, from this price action, I'm going to what? I'm going to enter the market early and then chase price upwards. You get what I'm trying to say? That is the equilibrium level. You can close the door for me. You can close it. That is the what? Yes. That is the equilibrium level. You understand? So if you want to enter the market early, then you wait for price to test the equilibrium level and say, okay, I've seen it test this equilibrium level. Henceforth, I'm going to place a trade and then I'm going to chase price higher. So you see, it was going up, down, up, down, up, down, got to this level. Then what happened? It went higher. Again, what do we look for in price? We look for the impulsive swing in price away from the equilibrium price level. That is found exactly in the halfway point of the consolidation range. Exactly in the halfway point of the consolidation range. Now, you can see that it went higher, came down, came near. That's why I say it's not all the time that it's going to enter the order block. Sometimes it enters the fair value, came near, and then what? It went up. But when you go on the higher time frame, I think this whole level is an order block. So yes, those are the elements you consider. Light just went out, so that's why this thing has become dark. Don't have light, but I came prepared, so nothing to worry about. So that's the interbank price delivery algorithm. I've explained everything that the interbank price delivery algorithm does. Please, when this video gets posted, go back to it. If you understand this thing, it's going to propel your anticipatory skills in price action. You are going to be able to anticipate prices. Okay, I've seen it do this. I'm going to take this strategy. Boom, I'm going to take this place. I'm going to take this. I'm going to do that. I've explained to you into detail what it means. I could have just come and say, okay, what do we have? We have expansion, consolidation, reversal, retracement, and not even show you examples. You understand? So when it gets posted, go back to it, watch it, um, study it. Don't just watch this one. Go back to price. Study it happen in price. Look at it over and over and over so that your eyes become familiar with it, such that when you see it happening, you can just say, okay, I've seen this thing happen. I'm going to take a trade. Bah, then you take the trade. You understand? Okay. So that will be all for today. Thank you guys for joining. And then when it gets posted, please go back to watch it. Send the links to your friends to subscribe and like. My aim is to reach a lot of people who don't understand forex market and want to understand the forex market. So I'm not just saying, okay, send it so that I get a lot of subscribers. I don't care if I get minimal subscribers. All my aim is to educate people on the forex market. And if that is what is bringing subscribers, fine. But I don't just want people to subscribe and they don't have anything to learn from my channel. Then that's not anything, you understand? So send the links out. When the video gets posted, you can share it on your status or your other um, platforms, and then we go on with that. So that's it. Elements to a trade setup. That's the end. Expansion, retracement, reversal, consolidation, order blocks, fair value gaps, liquidity pools, and equilibrium. Thank you guys for joining. I hope, do you have any questions? If you have questions, please bring them so that I answer them.
Okay.
Say again.
I don't think I have a question,
Okay. And
but if
if
I
you
do have, I'll contact.
exactly, please, when you have questions, send them into the group so that whilst I'm answering it, there's interaction. You understand? Send them. Don't be Obi and Obi. Don't be shy of anybody over there. Nobody is higher than anybody. Understand? I'll also come and then I'll answer in the group. Everybody will be happy, and then we'll understand. We'll have a level of understanding that gives them the ability to forecast price. So that will be all for today. Thank you for joining and have a good day. David, do you have a question? Okay, Jefta doesn't have a question. I think David doesn't have a question. That's why he's not responding. So thank you guys for joining. See you next time. Bye.